Right. Yes. Welcome to yet another class. Today we want to look at standard costing and variance analysis. We want to look at standard costing and variance analysis. Standard costing and variance analysis has a greater relationship when it comes to budgeting. Okay. So you must be attending this class after at least you've attended the budgeting class. Okay. So you know that when we speak about standard costing and variance analysis, yours is to first, of course, divide these two things. First, understand what standard costing, and then we shall try to understand what variance analysis is, okay? So standard costing in its own is basically, in simple terms, it's setting standards, setting certain, there could be a standard cost, it could actually be also a standard price, okay? So it's basically a technique where you set a standard cost or revenue for your products, for your unit products. And based on those standard costs or standard price, you're able to do an evaluation versus your actual price or actual cost for a unit product. And then you're able to get variances that may help you to make key decisions about your production, okay? Standard costing is so much common when it comes to manufacturing companies. And why? Because in manufacturing companies, we have some level of standardization, okay? If your company is producing, let's say, bottles of water, it's much likely that it produces similar units over and over time of that given bottle of water, okay? So we are also going to appreciate that the reason why we are saying it works more in manufacturing is because in the service industry, there's what we call the services that are the services that we offer from a service industry. They are not they are not that I don't know how to say it, but they are not equal to each other, just like the way it could be products, okay? And why I'm saying so is, if, for example, I'm handling this class for standard costing and variance analysis, and I'm doing another similar class of standard costing and variance analysis, there will be some differences between the two, just even like a haircut. Maybe when you go for a haircut, and today you're given that haircut, it will be a bit different from when you actually go maybe for your second haircut, okay? So it's good for you to understand that standard costing happens and works well with processes that are repetitive in nature, and that's why we're seeing it so much happen when it comes to manufacturing companies, okay? So standard costs, basically, an organization just gets to a point in time where it sets, say, a basis for measuring its performance, to say this is the standard material that is needed maybe to make it. I usually use an example of a bakery. So if you're saying that this is the standard material that can produce a single cake of maybe 5 kgs, and maybe you can say this is the standard maybe number of hours that labor should spend on this production, maybe this in terms of maybe the standard hours for which the machine should take in producing such an item. So you can look at different things, but I believe that background gives you more understanding on what standard costs actually are, okay? So just know that standard costs are preset. These are a preset cost or revenue or prices for management to base on to measure their performance, okay? So you know that these are not actually the same as budgeted costs, okay? Now, budgeted costs look at the entire organization, look at the entire activity, okay? Yet standard costs are on a single unit of product, okay? So you need to basically understand the standard cost is for the unit element of the activity, not for the overall. So, and that's why I said budgeting and standard costing have a relationship within them. We actually use the standard costs in setting budgets, okay? But remember, for the budgets we are doing now, the whole sum wholesome kind of, we are looking at the activity in wholesome or the business in wholesome, okay? So we basically need to know. So just an example here, for example, if let's say the budget output for product is, let's say 10,000 units. And then we are saying that if the standard cost per unit is 3 shillings per unit, then the budgeted cost will actually be 30,000. So as you can see, the 3 is the standard cost, okay? And then the budgeted cost is trying to take into consideration the whole 10,000 to give you what? To give you 30,000. So that is very important for you. So as the Chartered Institute of Management Accountants basically defines the standard cost as a predetermined cost, which is calculated from management standards of efficient operations and the relevant necessary expenditures, okay? Or it's an amount the firm thinks a product or operation of the process for a period of time should cost based upon certain assumed conditions of efficiency, economic conditions, and other factors. Now, one of the things that we shall see, the fact that you're setting it as a standard means that it should be something that is gotten out of conditions that are a bit streamlined, that are a bit perfect, I could say, okay? And I think you know what we call the engineering method, where management uses a technological approach to actually set different kind of standards. So this could be one of the ways that you set standards, which we shall see other ways, like maybe using historical information to set standards. But whatever standard you set should be something that demonstrates some level of efficiency and demonstrates some level of like optimal economic conditions, okay? Of course, the reality may really differ, but remember, this is a standard, okay? This is a standard which you want to use to apply to different conditions, okay? So it should really be standard in its nature, okay? So that is something that you need to basically take away. So basically, like we said, standards are so much used when it comes to activities that consist of a repetitive operation, okay, where you can do something over and over time. And like I told you, the manufacturing sector does it much very well, okay? Of course, it is so much limited to services, but we have certain services that might actually use this system. And as we can see, we have some examples here. For example, when it comes to the banks, we can have standard in terms of, let's say, number of checks or number of loan applications processed in a given period of time, okay? So that could be something that we can look at that level. But in most cases, we'll see that this is so much in the manufacturing, okay? Yeah, so how do we establish standards? How do we establish standards? How do we come up and say, for us to produce a 5 kg cake, it takes us maybe 10 kilograms of, okay, maybe it takes us maybe 3 kilograms of wheat and maybe 2 kgs or 2 spoons of sugar, whatever it is. How do we come up with such standards? Now, ours is to know that we have 2 approaches, like earlier indicated. We have the engineering method, okay? We have the engineering method, which is sometimes called the engineering studies. And then we can also get some of these standards from historical records. Now, when we say historical records, what we are trying to mean is that over and over time, you've been producing, let's say, these cakes, okay? And from experience, it has come to you that this is the amount of, let's say, sugar that is needed for a cake of this quantity, or this is the quantity of wheat that is required for this kind of cake, okay? So it's very important that you utilize not only just information from just one previous period, but it's information from different periods that is giving you an average that you can use to determine your standard. So, and then other is the engineering studies. The engineering method of setting standards definitely is you using a technological approach, and you basically do, it's like a laboratory test in its own, okay? Where you're able to say, now I want to determine how much it will take me to produce a 5 kg cake. So you say that, okay, now let me buy these materials. You're able to study, use cameras, you use what, and all through you make sure that you conditions are as much perfect as possible, okay? Because you're setting standards. Reason why this is also very key is, remember, one of the standards you also may want to set is the labor hours, okay? So you want to make sure that the hours that labor is spending on, let's say, producing that cake of 5 kgs are actually standard in a way that labor is not, let's say, distracted by anything that might be around, okay? So that is very important when it comes to the aspect of engineering studies. So make sure that you do that. Now, why engineering method is sometimes also maybe appreciated better than historical records is because historical records could carry over what we call previous inefficiencies, okay? We could have past inefficiencies that could actually come with previous records. Maybe, for example, you if it's a 5 kg cake, maybe you have been spending 3 kgs of wheat flour, but actually over, let's say, maybe a half kg has been going into spoilage, okay? Now, because you're using past information, you're going to still continue with the same thing and say, I need 3 kg, I need 3 kg. But when in reality, maybe half kg has actually always been in maybe spoiled. You get it? So that is why we're saying that instead of you using past information, you do an engineering study instead. Do create conditions and be able to study and see what exactly it takes you to produce, let's say, a 5 kg cake during the normal terms, okay? So that is very important for you, that you need to have that in mind. So you need to know what the two methods are and how one method is better than the other. So, of course, nevertheless, we are saying that the historical or past records is still one of the most used, because, of course, it's much easier, okay? It's much easier for you to actually do what? To come up with this, okay? So that is very important. So with that in mind, us understanding the different methods that are required to actually to set our standards, the engineering, and then the using the past records, ours is also now to go ahead to understand how do we set standards for each of the different parameters, okay? Like for the different costs that we do have. So you know very well that if it's a product, we have what we call the variable costs, and then we have what we call the fixed costs, okay? Or what other people we could call the overheads, the fixed overheads, whatever it is, okay? So part of the variable costs includes materials, okay? And as it includes materials, the question is, how do we set standards for direct materials, okay? How do we set standards for direct materials? Now, with direct materials, you have 3 things that you need to look at here. Remember, you have the quality of the materials. That is very key when it comes to standard setting, the quality of the materials. You also have the quantity of the materials, and then you also have the price of the materials, okay? So management should be able to have a given standard in terms of what is the quality that we work with, what is the quality of raw materials that we need to work with every time we are going to production, what is the quantity that is needed, like we've seen, what is the quantity needed to produce a single cake, okay, in that case. And then also price, like what should be our standard cost of getting these materials to be used in production, okay? So that is very key. So of course, in the same way, once we have those parameters or those standards, and we've understood that we can either base on the past information or do an engineering study, okay? And of course, through the engineering study, we may go to, if it's materials, we may have to, let's say, maybe go to, just look at the material, evaluate on what maybe the components, maybe if we are looking at the aspect of quality. We might also go ahead to go to the market, do a market research to determine the actual price of these materials, and so on, okay? So this is very important for us to have that in mind. So that is what happens when it comes to the direct materials. And of course, utilizing, let's say if we are trying to look at maybe the internal support system, of course, when it comes to quality, the production department comes very key because they're the ones that are doing the production, so they understand what kind of quality they work with. And then when it comes to price, definitely the procurement or purchasing department will come very handy here to be able to tell us on how much do these materials actually cost in the market, okay? So that is very important that we take that into consideration when we are setting our standards. So we have, of course, we have challenges that come with setting standards. And as you can see, one of those could be, of course, one of those could be to do with it being often difficult to establish a realistic allowance that should be made for defective materials or for spoilage arising during production. Now, of course, we know very well that if you put 3 kgs, let's say in a cake, okay, you may not actually get all the 3 kg replicating within the final product, okay? The same thing with sugar as well, or with same thing with water. You find yourself that maybe you've put maybe 2 cups of water into something, and at the end of the day, you actually only able to get, let's say, maybe 1.5 cup that is reflecting in the final product. Now, it's more often difficult to take into consideration the spoilage because this is something that can hardly be done what may be determined, okay? So that is very key. And then one of the other things that we also may need to take into consideration is that you may have different suppliers, okay? You may have different suppliers for the same material. And of course, this may bring about variances in quality, okay? So that is one of the other problems that might come here. And then also, if at all we are maybe setting standards on a basis of test runs, and now test runs, that is part of engineering. The engineering method means that these test runs should be as realistic as much as possible, okay? And then of course, still the price of raw materials keeps on changing, and this may of course affect when it comes to, let's say, your price variance, okay? You may have cases of where you have much of the value of the standard being lost. So that is very important. So those are just a few challenges that you might come with when you're setting some of these standards, okay? Then we have what we call labor, okay? We have what we call the direct labor. Now, direct labor is another, of course, is another component of our variable costs. And when we are setting standards, because remember, at the end of the day, the reason why we are looking at materials and looking at labor is we want to accumulate this all together and determine the standard cost of producing a single product. So we appreciate that in producing a product, we actually need labor. Labor is a key factor of production, okay? Now, understanding that, I was ask ourselves, so what do we exactly do when we're actually setting the standard for labor? And for labor, the things that we are looking at here, of course, is the hours that labor takes to produce a single unit of a product, as well as also understanding of how much per hour does labor cost us, basically your labor per hour unit, okay? Or rate. That is very key for you to understand. So with that in mind, ours is to know that if we are setting standards for labor, what do we do? Are we using the engineering method like we've indicated, where you do technological observation and so on, or we are also basing on the past, let's say, information? Of course, when it comes to labor rate per hour, we may also use, let's say, maybe labor union rates and so on. Maybe if we have a wage law around, we may want to take that direction as well. But all this information, we have it within the organization, if at all the organization has been running, okay? So you're able to determine and say, maybe this is what, if I'm paying labor that produces maybe these cakes, maybe a labor should take maybe about 5 hours in producing maybe this quantity of cakes, and maybe knowing that maybe this same labor will be paid maybe 10,000 per hour, okay? So it is something that you need to make sure that you understand, okay? Yeah. So one of the other things that also, of course, when we are setting standard, especially for time, we are saying we should look at the past performance records, how labor has performed previously. Of course, you can do a test run where we are doing like kind of a production that is more of a test run. So, and then we can also look at aspects of work study, okay? So that's important when it comes to setting standards for labor. So in the same way, we also have some challenges for labor, okay? And what we are saying is, of course, that the departments that have to supply the basic information may not be competent to give us this information without guidance. Okay, this could be maybe the HR to provide us how much they should pay labor of a given category. And then, of course, understanding the operations involved in carrying out the job have to be clearly established. Okay, so that is very important. And then one of the other things that we also need to know is that, you know, the patterns of labor may also keep on differing based on, let's say, how long they have worked. Okay, if you part of this, you remember when we just studied about the learning effect. Okay, now when we are setting the standards for labor, you get realized that if the learning effect might also come into play here. Okay, if we are setting the standards for labor for year one, that would definitely have would definitely a bit be different when it comes to let's say setting standards, for example, for let's say period 2. Okay, so that is very important that you take into consideration that. Okay, and then also understanding, once we have that in mind, just a moment. So that is what exactly happens. Okay, that is exactly what happens when it comes to making sure that you looking at labor. So there are several of them that you can find here. Okay, and of course, one of the other things is work measurement may also be required, and this could be lengthy and costly in operation. Okay, and then of course, one of the other things is the different operations may not include may not coincide with the separate cost centers. Okay, and so on. So that is what happens with labor. So the other that we also have is setting standards for overheads. Okay, so remember, when it comes to like factors of production, it's not only materials, labor, but we also have the overheads as well. So in setting standards for overheads, what we are saying here is that we have a breakdown between the overheads. We have the variable overheads, and then we have the fixed overheads. Okay, so when it comes to setting standards for let's say the variable overheads, what we are trying to say is we adopt the use of the standard variable overhead absorption rate, which is basically budgeted variable overheads divided by the budgeted standard hours. Okay, so that is very key for us to understand that. And not only that, different when it comes to the fixed overhead absorption rate, which helps us in determining this or the setting the standards for the fixed overheads. Okay, so that is here basically the key principle is that we use the absorption rate, okay, in setting the respective standards. So ours is to determine what are budgeted variable overheads divided by a budgeted standard hours. As you can see, in most cases, the budgeted standard hours for variable overheads are in most cases the labor hours, okay? Because these are variable costs. These are usually labor hours, okay? So that is also for you to note. And then of course, when it comes to here, to the fixed overheads, these budgeted standard hours could either be, depending on what is, are you using the traditional method, or you using maybe another absorption method? Because with the traditional absorption method, could be labor hours that you're using to absorb, or could be, let's say, maybe you're using machine hours as well. Okay, but this is the key principle here, so you able to know this. Now, of course, one of the things that we need to understand is, of course, the fixed overheads are usually constant. Okay, so it means that we also want to think that the standard will also be able to have some level of not changing so much. Okay, yeah. So in the same way, we also have some, of course, some challenges when it comes to setting standards for overheads. Okay, and those ones, one of those could be actually being able to distinguish between what is variable and fixed. That could also be one of the things. But establishing, of course, in the same way, establishing these overhead costs before you actually, let's say, get into production may also be a little hard, especially when you maybe you're in the first year of production. Okay, and in the same way, of course, if you're trying to use let's say you're trying to use maybe past results, this could also come with a lot of inconsistencies there. Okay, so it's very important that you understand that, and then also understanding that, of course, the costs should be related to a normal level of activity. And of course, the activity could also be very difficult to define. Okay, now, one of the other things is the standard of the output also must be determined. And of course, this is also necessary to determine the overhead costs that should be incurred at those different levels. So those are some of the challenges that you may find along the way when you're setting the standards for overheads. Okay, so we also have, of course, establishing standards for a process, cost and job order cost system. Okay, and right here, if it's, for example, a process cost system, what we are saying is we set standards separately for direct materials, for direct labor, and then also the same thing for the direct for the factory overheads. Okay, and then if for example we have more than one department, then what we are also saying is that the indirect standards are set for each of the department. Okay, so just like the way we did for the respective cost elements, the direct materials, the direct labor, and the factory overheads, we're also saying that if it's the same thing also, that we have more than one department, then we have to make sure that we are doing what? We setting standards for each of the department, the direct standards. Okay, so that is very key when it comes here, especially when it comes to the process. Now, also, when it comes to the job cost system, we are saying that each job should have standards set for direct materials, direct labor, and then the factory overheads as well. Okay, so you make sure that you have different standards for each job, as well as also knowing that if it's a process cost system, you have separate standards, okay, that are set for the direct cost elements. And if there's more than one department, then you use this to make sure that you also have different standards for the direct standards set for each of the department. Okay, and then we also have setting standards for the sales margin. Like we said, when you call it standard costing, it does not ideally mean we are excluding the element of price. Like I said, we can also have a standard price, okay, for a product. Okay, so having that in mind means that if we are setting a price, a standard price for a product, okay, we have to make sure that we take into consideration the key factors. And some of the key factors here could, for example, be the demand of the product, okay? Because you know that demand influences price. as well as also looking at the competition available. And so when we are speaking about competition, we are also looking at what is the competitor's price as well. And then also understanding what are the production costs that we definitely incur in producing, because cost is also a key element of the price. And then also taking into consideration any inflationary trends that may actually happen into the future. So those are key factors when we actually setting our standard price, our standard selling price, okay? And then also knowing that, of course, if it comes to, let's say, setting, let's say maybe the selling margin, okay? If then that should be basically the difference between your standard selling price and the standard cost. Now, like you see, all these that we are doing as standards does not mean that we are setting the actual price that we are going to sell to. And one of the things that you get realized that when we are doing now the actual implementation, the actual operations, you get realized that we actually have different actual costs of materials, different actual costs of labor, as well as maybe different actuals for our overheads and so on, okay? Including, of course, the price and other elements. So it's very, very good for you to understand that these are just standards, okay? At the end of the day, management wants to measure itself on those standards. So it's not that it wants to transfer these standards into the actual production. It just wants to set a standard and say, this is my standard, so I can measure my source at the end of the day, okay? And then we have, of course, the problems that might come in setting standards. And these are basically general. Like we've seen, I think we've just done each of the different elements, materials, labor, overheads, and so on. But then we also have the general ones that you may also just need to pick a few of them, okay? Of course, one of them is deciding on how to incorporate inflation into the planned unit costs, okay? And then the other one is agreeing on the performance standard. Either you're taking attainable or ideal. Now we are going to look at different types of standards. And one of the example or types of standards is ideal. Now, ideal standards, those ones are basically calculated that assuming perfect condition. And then attainable, those are usually basically they are realistic, okay? They are realistic standards. So when management is setting standards, it also asks itself, am I setting ideal standards that are for perfect condition? Am I setting, let's say, attainable standards? Am I setting, let's say, basic standards, okay? Or am I setting also standards that are from past performance as well? So we shall see that now. Agreeing on what standard to do is a challenge between management and the operations team, okay? Or the people that actually go on. Because at the end of the day, no one wants to be measured on something they cannot achieve, okay? So there are usually struggles in there, as we shall see. And then also deciding on the quality of materials to be used. Of course, management will be in a conflict between quality, okay, as well as cost, okay? Should we have something of better quality, or should we have something of, let's say, that is less of cost? Of course, we know that if it's a high quality, it requires a high cost, okay? So there will be a conflict right there. And then also establishing material prices, especially where we have the fact that prices of materials keep on changing. That might also come into play, especially also understanding that even when you have bulk discounts, the prices may also differ, okay? And then also the other one is making sure that you also find, of course, sufficient time to construct accurate data. And like, for example, as benchmarking, this could be time consuming. Basically, the whole process in itself is costly, okay? The cost of setting up and basically manufacturing a system for establishing standards is very costly, okay? Yeah, and so on, okay? So those are some of let's say the problems that you could think about, okay? So we have standard hours produced, okay? Now, one of the things that we need to highlight here, like I said, that when it comes to setting standards, it is much common when we are working with a repetitive process, okay? When we are working with a repetitive process. But then a case in point is where we have a department that produces 100 units of product X, 200 units of product Y, and then maybe 300 units of product Z. Now we are saying that, of course, we cannot easily add the units and say maybe 100 plus 200 plus 300, that gives us about maybe 600 units. We cannot add this because these products are not homogeneous in nature, okay? They are not the same products. So ours is now to say that if we are to overcome this, then we shall add the hours instead, okay? We shall then add the hours or the time that it takes to actually make each of these products, okay? And that, of course, that calculation is called the standard hours produced, okay? So you know, especially when it comes to, so that is what happens when we have the non-homogeneous products, like this example we've been given, okay? Yeah. So we have the types of standards like I indicated. Now we have the basic standards, okay? Now the basic standards, these are usually, of course, they are basically, just from the word basic, okay? They are basically used to work for a period that is a little longer, okay? Because they are not ideal. They are basically basic standards that management just comes up and they want to use this for a period that is, let's say, a little longer, okay? And then also one of the things that also happens with the basic standards is they provide, of course, they provide a basis of comparison with the actual costs for several period of years, and then also knowing that they're also able to have it in mind that maybe we might have circumstances where maybe efficiency may change. And then also, one of the things that you also may understand, the basic standards are more friendly to use when you are in a little stable situation, okay, where things are moving the same way. And that's why they are basic in nature. So if a business is operating in a bit stable conditions, a bit stable situations, they may choose to actually adopt what are the best standards. Of course, one of the limitations with the best standards is, in most cases, they are not realistic to different seasons. They are basically basic in nature, okay, from that. And then we have the ideal standards. Now, these ideal standards, these are the ones that you generate using your engineering method. And sometimes we call them the engineered method, engineered standards, okay? Now, in these, basically, these are standards that are developed as a result of perfect condition. You basically assume perfect conditions. And in perfect conditions, we are trying to mean there is no wastage, there is no scrub, there is no breakdown, there is no idle time, there is no inefficiencies. Basically, everything moves just the same way they should move from the start to the end of the process, okay? So that is very key, okay? So of course, ideal standards, of course, have an adverse issue when it comes to motivation. And why that happens is they are ideal in nature. It means that after you've set these standards, management that is going to implement to do the actual production, in most cases will not meet these standards because these were made in an ideal situation, and management does not work in an ideal situation. Management works in a situation where there are delays in delivery of raw materials, where there are power cuts, power shortages, where there's machine breakdown and they have to come and repair the machine, where there are things like, for example, there's wastage, okay? Maybe because of a machine that does wastage, paper jam, and so on, whatever it is, okay? So that is why we are saying that they have a big effect on motivation, okay? Yeah. So then we have what we call the attainable or normal operating standards. Now, these ones are basically standards that can be achieved, okay? These are standards that can be achieved. So management is able to take into consideration any challenges that might come along the way, like things like wastage, things like any maybe machine breakdown. So it knows that maybe every week a machine may break down, maybe once in a week. Okay, so management is able to take into consideration all that, and then it goes ahead to set these standards. Okay, and then of course also knowing that these attainable standards also could they're basically not perfect. They're not determined through perfect conditions. Okay, they're basically, they take into consideration any changes that may really happen into the conditions. Okay, so that's very important to understand. Sorry, when it comes to setting these respective standards. Okay, yeah. So like we're saying, they take into consideration this. They recognize that manufacturers do not operate 100% capacity. They also they say normal spoilage will occur. Okay, we shall always have spoilage. Direct labor is not 100% efficient. Okay, these are the allowances that they actually make when they are setting these standards. Okay, and then we have the other one, which is current standards. Okay, now current standards are a bit opposite to basic standards. These current standards take a little shorter time. Okay, they take a little shorter time, and they basically reflect conditions applying to the period under review. Okay, they basically reflect to the conditions available, the current conditions. So that is what happens with the current standards. Okay, all right. So that is what happens with the current standards. And then one of the other things, okay, that we want to appreciate as well, of course, you might also have things like negotiated standards. Okay, negotiated standards, or you can also have something like expected standards, but really very similar principle, because negotiated standards might be, for example, standards that management and the implementation team sit together and agree to and say this should be the standard. Basically, there's involvement. Okay, and then expected standard, of course, they are usually standards that apply to a given specified budget period. Okay, and they are also based on a normal efficient operating condition. Okay, so it's good that you understand what are the types of standards. And then we have, of course, the purposes of standard costing. Like, why do we do standard costing in general? Okay, now, so you understand, standard costing helps us predict future costs that can be used for decision making. Like, for example, if we are maybe producing, let's say, the cakes that I've been highlighting here. If we want to say that we want to double our production in the next financial year, we are going to use the standard costs to determine how our costs will be like. Okay, and that alone can help us make decisions on certain things, either outsource, either whom to buy, either what, if we are taking on the decision or not. So whatever it is, that helps us. And then also one of the other things that also you need to take into consideration, that setting the standards provides a challenging target for individuals to be motivated. Now, just imagine, just like the way we are studying the CPA exam, your standard mark is 50 that you're working against. Now, if you didn't have, let's say, this standard mark, and it was just like, you can just earn any mark and you'll be able to pass, I'll really know that you may not even be taking a lot of time to go through this kind of information, because any mark that you earn, you actually pass. Okay, so when you have a standard mark, it pushes people out of their comfort zone to go and push and ensure that they're actually performing to meet the set target. Okay, so that's very key. And then one of the other things that also happens with standard costing is that it assists us in setting budgets and evaluating managerial performance. Like I said, standard costing and budgeting work hand in hand, okay? They work hand in hand, and in a way that when you want to draw up your budgets, you will definitely use the standard cost. Like we said, with the standard cost for the single unit of the activity, okay? So if you want to do the a budget for the whole activity, then you just use the standard unit cost multiplied by maybe the how repetitive you're going to do the activity, okay? So that is something for you to take home. And then we proceed to the standards act as a control or device by highlighting those activities which do not conform to plans. Remember, when we set standards, there's also what we call the standard variance analysis. Management is able to do a standard variance analysis between what it set and what it has actually achieved. And then it's able to know if it's moving rightly or there actually needs to be a corrective action, okay, that is to be made. So that is very true. And then, of course, simplifying the task of tracing costs to products for profit measurement and inventory valuation purposes would also be one of the advantages of the standard costing. So standard costing has limitations, just like the way we had, remember we just looked at the problems with standard costing, okay? So you could also add limitations here. And as you can see, the process itself is time consuming, okay? We also have changing conditions. So today you set a standard and say my standard price of a kilo of wheat flour is, let's say, maybe 8,000. And because of market conditions, the price just goes, like just doubles, okay? Now that alone affects you, okay? So you cannot, you may not have full control over your standards. They keep changing, okay? And then some staff may see the standards to be a pressure to them. Just like the way you have the 50% mark may cause pressure to you, especially during the last days of preparation for the exam, because you want to make sure that you actually hit the 50% mark, okay, and beyond. So that is very key. And then, yeah, responsibility of the cause of variance is not always easy to identify, okay? And of course, once we get to the variance analysis, you'll be able to see that we get different variances, like maybe price variances, maybe things to do with mix variances and yield variances and so on. But the whole principle here is that there's some circumstances where you actually fail to find out on why you're actually getting a variance, okay? Maybe you budgeted to sell 200 units and you've only sold 10 units and you can't tell what has really gone wrong, okay, when it comes. So that is very key for you, okay? So with that in mind, let's see how now budgeting and standard costing is related, okay? How budgeting and standard costing, like we said earlier on, we said that standard costing looks at a single unit, okay? And then budgeting looks at the overall activity, okay? Now, when we are doing budget control, okay? When we are doing budget control, basically what we are doing is we are comparing what was our, let's say, budgeted cost vis-a-vis our actual cost, getting the difference, which is the variance, okay? Now, standard costing, for it is trying to make a comparison of the estimated and actual results of manufacturing a product or providing a service. So for it, it means that it is more concerned with just a unit of the product, while budgeting is concerned with the whole organization, okay? So that is very key. So just a breakdown here of what are some of the differences. And as you can see, the first one is more about the unit, and then the other one is the budgeting is for all the units, okay? I think standard costs are mostly set for manufacturing function. Budgets are set for all functions. HR will have a budget, marketing will have a budget and so on. Okay, so yeah, standards emphasize the cost to be anticipated under expected working conditions. Okay, okay, working exceeded conditions, where budgets emphasize cost of targets that should be exceeded, and so on. So we have different differences that you can think about, but at least I believe you understand what exactly the two may differ. So we have, as you can see, we have how they can be, how they are a bit similar, and how they are similar. One of the aspects is the setting of targets or standards. Okay, both standard costing and budget control have elements of setting standards. Okay, and then they also have an element of looking at the actual results. Okay, or recording of actual results, and then they also have a similarity of comparing actual with what has been set in terms of standard. And then the other is making sure that computation of variances, and then their analysis and so on. So very important for you. So with that in mind, we now move to what we call variance analysis. Okay, we now move to what we call variance analysis. Now, like we said, it does not only end on setting the standards, but rather we should get to a point in time where we can evaluate and compare standards, our standards, with actual results. Okay, and this could also not only be about the standard cost, but could also be around the planned cost or the budgeted cost as well. Okay, so with the variance analysis, we're also going to look at, if you've set a budget, how are we able to determine the respective variances when we are comparing with the actual. Okay, so once you're doing your comparisons, definitely we have two key terms here. If your actual results are better than the expected results, you have a favorable variance. Okay, and if the reverse is the same, where your actual results are worse than expected results, then we call that adverse. Okay, so that is the key principle. So yours is to know that if I'm trying to get either favorable variance or adverse variance, main is to compare with actual results. So get actual results. Okay, maybe subtract the budgeted results, and if you're getting, let's say, a positive, if it's, for example, if these are expenses, okay, if these are expenses and maybe your actual result is maybe 20,000 and you budgeted for 10,000, okay, it means that you have a favorable variance for expenses. But if it's revenue, if your actual result is higher than, of course, your budgeted results, still for revenue it will be okay. But if it's for cost, if your costs are higher than what you budgeted for, then that will be an adverse. Okay, so you have to know how the two items work when it comes to expenses and revenue. Of course, like you see, if we spend less than what we budgeted, we are better off. And if we are earning more than we actually budgeted, we are actually also better off. So we have a requirements of a good variance analysis. It should be, of course, meaningful and realistic. Okay, it should be possible to measure performance objectively and correctly. Variance information should be very simple to be effective. Okay, to be understood by the respective departments that are doing the actual implementation. And then you should also be able, variance analysis should be able to tell us on why the variance, okay, basically the responsibility of the variances. And then also it must be possible for us to control the production variable. Okay, yeah, so that is something for us right there. And then we have now the purpose of variance analysis. Why do we have to do variance analysis? Okay, just like the way we have seen why it is important for us to do the standard costing. We also have key reasons why we do variance analysis. And basically the key principle here is to determine what if we have performed well or not well, and for management to actually take corrective action where we have any variances. Okay, that is the key principle that you need to take into consideration when you're doing variance analysis. That is the key advantage, or that's basically to determine if we have any variances and check where are they coming from. Okay, what is the cause of the variance, and then management should be able to take action. Okay, so we have key categories of variances. Okay, so we have sales variances that are so to do with sales, okay, or sales revenue. And then we have the variable cost variances. Okay, we have the variable cost variances, and then we have the overhead, which is the fixed and variable variances. Okay, so having that in mind, ours is to understand what is the sales variance and what are the components of the sales variance. Okay, now sales is revenue. Okay, and with sales, the parameters you're looking at here are things to do with price. Okay, remember sales is price times quantity. If you want to get your sales revenue, it will be the price of your commodities times the quantity that you've sold. Okay, now if for example you budgeted for, let's say, $10,000 to sell in 1 month, and you actually end up selling maybe $20,000, the difference between 10,000 and 20,000 gives you a total sales variance. But that total sales variance could be as a result of a change in price or a change in quantity. You might have either sold more, or you might have either sold at a higher price. Okay, so that is what we are trying to look at here. So a selling price variance measures the effect of expected profit of different selling prices to the standard selling price. Okay, it's basically calculated between what the sales revenue should have been for the actual quantity sold and what it was. Okay, that is the selling price. Now selling price, as you can see, this is the summary of it. What sales revenue should have been for the actual quantity sold and what it was. Okay, so a case in example, if you sold, maybe you have 1,000 units and each unit is 50 shillings. Okay, 1,000 units and each unit is 50 shillings. Now if you go on to sell, if you go on to make a sale, and let's say for the 50 unit, okay, for the 1,000 units, instead of selling them at 50 shillings, you actually sell them at 60 shillings. Okay, so we are saying that the variance will be what sales revenue should have been. So the sales revenue should have been the 1,000 times the 50 shillings, which is 50,000. Okay, but if you sold it at 60, that is what it was. So it will be 1,000 times 60 to give you the 60,000. So the difference between 60,000 and 50,000 is actually what? Is actually your selling price variance. Okay, yeah. All right, and then we proceed to what we call the sales volume profit variance. Okay, the sales volume profit variance. Now, sometimes they may call it sales volume variance. Like I said, sales revenue is influenced by two things. It's influenced by the price and the quantity. Okay, so the reason why we are determining the sales, remember up we've determined the sales price variance, and here we are determining the sales volume profit variance. So make these two words. Here price is the key factor, okay? Is the key factor that is changing. It is the price variance, it's the price that is changing. When you come to down here, what is changing is actually the volume. So in this case, it's the volume that is actually changing. So what we are saying that this is the difference between the actual units sold and the budgeted or planned quantity valued at what? Valued at the standard profit per unit, okay? So just like the way we've called it sales volume profit variance, in this case, we are valuing this at profit, okay? We are valuing this at profit, not at price. So that's very important. So if, for example, this was the case, what I would basically do is, if I was trying to look at this, mine is to look and see what was my actual quantity, okay? Maybe if my actual quantity was 1,000, okay? My actual quantity was, okay, my planned quantity was 1,000, but my actual quantity may actually be, let's say, 500, okay? So that is the difference, the 1,000 and then the 500, okay? Maybe let me use my actual to be 600 so you can get the picture very well. So if my actual is 600, that means that the difference between the two, 1,000 and 600, that gives me 400. So the 400 should be multiplied by what? By the standard profit per unit. So the standard profit per unit definitely would be already given to you, okay? Would already be given to you. And maybe my standard profit per unit was, let's say, maybe 25 shillings, okay? Or 20 shillings. It's 20 shillings, so I'm going to multiply the 20 shillings times the 400, which 400 was the 1,000 budgeted, actual 600, and then you get 400 and multiply by the standard profit per unit, okay? So that is the key principle. That's what we basically do. So why, like I said, why does sales revenue vary? Sales revenue would vary because of change in price, and then would also vary, of course, where we have changes in quantity as well, okay? And then in expounding this, we may also look at unplanned price increases. Of course, this affects your sales price variance. Unplanned price reductions in the same way. This would affect your price variance. We can have unexpected fall in demand due to recession. This would definitely also affect your volume variance. Remember, this affects quantity, okay? Quantity that is demanded, demand moves with quantity, and then additional demand attracted by reduced price. This would also affect your volume variance. Basically, what is bought is more than what you had planned. Then the other is failure to satisfy demand due to production difficulties. That definitely will affect your what? It will definitely affect your volume variance, okay? Yeah, so that is something that we need to take into consideration. Once we have understood what our sales variance might be, ours is now to look at what? To look at the direct material variance, okay? Ours is to look at the direct material variance. Now, here, like we said, material, we are trying to look at in terms of the cost, okay? We are trying to look at the cost of the material, which we are going to call our direct material total variance, okay? And then we have the direct material efficiency or usage variance, okay? Efficiency or usage variance. So when it comes to, of course, when it comes to material, in the same way, we can also have, apart from just having the direct material, total variance, we can also have what we call the material price variance. Okay, we can also have, now this is the total. This is the total, but then we can have the direct material efficiency or usage variance. And in the same way, we can also have the material price variance. Okay, so you need to take into consideration. And like we've indicated, the total variance is total. Like you see, it's the difference between what output actually costs and what it should have cost in terms of materials, full stop. Okay, yeah. And when it comes to efficiency, what we are trying to look at here is in terms of the difference between the standard quantity of materials that should have been used for a number of units actually produced and the actual quantity of materials used, okay, valued at the standard cost per unit of materials. Now, we know that materials are usually, like I gave you an example that you might mix, let's say 200 maybe kgs in a production of, let's say, what can I say? Okay, maybe 200 may be high. Let me just use 2 kilograms. If you're mixing 2 kilograms in the production of a 5 kg cake, okay, that would be maybe your standard, let's say your standard material cost or kg, okay? Now, just in case, instead of using 2 kgs, you actually used 2.5 or 3 kgs. Now, that would have caused what? That would have caused a direct material efficiency or usage variance, meaning that you used more material than you would have actually needed to use. So we're able to determine that variance accordingly. Okay, yeah. So that is good to note. And then when it comes to the price variance, which I've just talked about, here we're trying to look at the difference between the standard cost and the actual cost, okay, of the materials multiplied by what? Multiplied by the actual quantity of material used or purchased, okay? Yeah. All right, so good to note there, and also understanding some of the challenges that we might have when it comes to that, okay? We also have, when it comes to materials, we also have what we call the material mix variance, okay? And when we are speaking about material mix variances, here we are looking at basically mixing, from the word mix, and it looks at products that are made by more than one product, okay? And here is an example of cement and sand that is making maybe a brick, okay? So if a brick is made by cement and sand, yours is to ask yourself if there's an alteration in the mix of cement and sand, okay? What would that have an effect, okay? Remember, what we are trying to say with the mix variance is we are trying to say the portion of direct material usage variance that is due to the change between the standard and actual composition of the mixture, okay? So are we having let's say a variance, okay, due to maybe we, instead of using, let's say, let me use even here, maybe in terms of quantities, maybe to produce maybe 50 bricks, you require maybe 10 kgs of cement, okay? Maybe you require 10 kgs of cement, and maybe could be maybe you need about 40, okay? Maybe 40 kgs of sand, okay? So basically what you're doing with the material mix is you're trying to get the two things together and saying, instead of doing that mix, maybe I did another mix instead of doing the 10 kg to 40, I actually did maybe 5 kgs of cement on maybe 45. Okay, so you're able to determine what your mixed variance could be. Okay, we're going to look at this and see how it plays. Okay, yeah. So just know that material mix variances happen where there's an alteration in the mix of the materials that are required to make a given a given product. Okay, so in terms of steps that are used in calculating this, we are saying that we basically determine the standard mix ratio. Like for example, the example I've given, if I'm looking at my sand and my cement, my standard may be 10 to 4, okay? 10 to 40, which is the same thing as 1 to 4, okay? 1 to 4. So 1 to 4 means that if that is my standard mix ratio, so I can be able to determine what is my actual mix ratio, to actually go ahead to determine what? To determine my material mix variance, okay? Yeah. And then also ours is to standardize the actual usage, okay? And that is actual usage in standard mix proportions, okay? Yeah, and then understanding, comparing that you're comparing the actual usage in standard mix proportions vis-a-vis the actual usage in actual proportions. Yeah, so that is what exactly happens, okay? So we're going to see how that plays. So we have some issues here involved in changing the mix, okay? Remember, changing the mix may affect quality, okay? May affect the quality of the product. And that would mean that customers will also be affected, our customers who buy from us, okay? So one of the things we want to do is we don't want to encourage, especially our production managers, to alter these variances, because, for example, if a manager, for example, the standard is 10 to 40, and they alter and do 5 to 45, yes, they might have saved cost, okay, but in one way or the other, they may actually have another cost of loss of customer satisfaction, okay? So that is very key when it comes. So the mix variance, once you're evaluating it, you need to have that in mind, that it should not encourage poor production or poor quality production, okay? Yeah. So that is good for us right there. So then we have what we call the material yield variance. Now, material yield variance is not in any way different to what? To the material mix variance. Remember, what you mix gives you result, okay? It's the mix that gives the result. So as we have seen with the material mix variance, when we are looking at the material yield variance, okay? Here we're trying to look at the part of the material usage variance, which is as a result of the difference between the standard output and the actual output, okay? Like you expected to get maybe out of, let's say, a mixture of 10 kgs of cement and 40 kgs of sand, you expected to get 50 kgs of bricks, okay? But you rather got 45 kg of bricks, okay? So the difference between the 40 and the 45 and the 50 is actually representing that material, that part of the material usage variance, okay? Yeah. So this is output oriented, okay? This is output oriented. So you know, so yours is, if you want to calculate this, like we're saying, that is the difference between the actual output and the standard output multiplied by the price per unit of the standard output, Okay. Yeah. If I'm using my example of sand and cement, and remember, if the kgs that are used to produce, let's say, the 50 kgs of the bricks, maybe I need 10 kgs of cement and 40 kgs of sand. Okay. In case I use maybe the same quantity, 10 kg of cement and 40 kg of sand, and instead of getting 50 kgs of bricks, or instead of getting 50 bricks, I actually get, let's say, 45 bricks. Then mine is also determine how much is each brick. Okay. If each brick is sold at maybe 1,000, okay. So if I'm to compare how many bricks I would have gotten, which is 50, then less what I have actually got in terms of the bricks, which is 45, and multiply the 1,000, it should be able to give me what? To give me my material yield variance, because the material yield variance is basically the difference between the actual output, which we are calling our yield, okay, and the standard expected output, okay, the standard or the expected, okay, output multiplied by what? Multiplied by the price per unit of the standard output, okay, to compute the materials yield variance. Okay. Yeah. So we are saying that if the actual yield is more than the standard yield, then we want to say that the material yield is actually favorable, and the vice versa is also very true. Yeah. So that is what we need to do. So as you can see, in terms of the steps for the actual, ours is first get what? The actual number of units manufactured, okay, which is the total quantity of materials that should have been used, okay, and then compare the standard quantity of materials that should have been used with the actual total that were used, then get the difference, which will give you your yield variance in material quantities, okay? And then you're able to convert this into money value by applying the standard material cost per unit. Yeah. So when to calculate these two, we calculate the mix and yield variance when a proportion of material in a mix are changeable and controllable. Okay, like for example, sand and cement. Then we also use this where the usage variance of individual materials is of limited value. Okay, because of variability of the mix, and the combined variance for all materials together is more helpful for control. Okay. Yeah. So that is very key. And like of course they are telling us if at all the material mix is discrete, then we shouldn't have a material mix variance. Okay. Yeah. So we have a case here, a relationship between material variances and opening and closing stock. Okay. Difference. Basically, what we are saying here is, of course, the direct material price variances are extracted at the time at the receipt of materials rather than the time of usage. Remember, you don't value your stock at the time of usage, but rather at the time when you actually get this product. So it's the same time that you should also look at your direct material price variances. Okay. Yeah. So we have a case here. We're saying that suppose the company uses raw material P in the production, and this raw material has a standard price of how much? 3 shillings per meter. Okay. So during the month, 600 meters were bought for 18,600. Okay. And 5,000 meters were used in production. As you can see, 6,000 meters should have costed what? 6,000 times let's say times the standard standard price per unit, okay? But here we are buying, okay? So we are saying that at the end of the month, inventory will be increased by what? By 1,000 meters, okay? Now, in the variance analysis, ours is to decide the material price variance, okay? And we are saying, should it be calculated on the basis of the material purchased, which is 6,000, or the materials that are used? Now, all you know is that this should be used, we should use what? We should use the time at which the materials were received in the company rather than what? Rather than the time of usage. So we'd rather use the 6,000, not use the 5,000, okay? Yeah. And then also, of course, that would also be based on also how we value, of course, our inventory, okay, as well. Yeah. Okay. So if we value at standard cost, definitely this will be 1,000. The variance, our variance will be 1,000 times 3 units, okay? And then if we value at actual cost, it will be 1,000 times the 3.10. Now, how they determine the 3.10 is right here, okay? Remember, when you divide the 18,600, okay? When you divide the 18,600 divided by the number of units that we have at hand, okay, divided by 6,000, you actually get the 3.1, okay? The 18,000 divided by 6,000, you get the 3.1, okay? So as you can see, if you are using standard costing, we are getting the 1,000, the difference between this, and multiplying it by 3. Then if we are using the FIFO, as you can see down here, okay, or actual cost, we are saying we use the 1,000 times the 3.10, which 3.10 I said is your actual unit cost, which is 18,600 divided by what? Divided by 6,000, okay? Yeah. Okay, so that is what happens with our material variances, okay? So this other information, you can be able to read it very easily, okay? So we have a case here, okay? Here we're trying just to calculate the price variance, okay? As you can see, since we are basing on the materials that were bought, 6,000 times 3 minus the 18,600, and we're able to get our respective price variance. Now, the other that we also need to understand is the labor variance, okay? Remember, we said that we also set standards for labor, okay? Because we set standards for labor, we can also determine what? We can also go ahead to determine the variances for labor, okay? Now, the variances for labor are also in 3 categories, okay? We have the total labor variance, we have the labor, the variances for labor actually cascade even more than that. We actually have the labor rate variance. We also have what we call the labor efficiency variance. And then we also have what we call the idle time variance, okay? We have what we call the idle time variance, okay? Yeah. So I want to share with you an example here that can give us a picture of all this that we are trying to look at, so that it's more practical for you, okay? Even as we get down to the overheads, okay? So there's a question. Just go down here and see. I want to see something that can help us understand these variances much better. Let's see this one. This may not. Let me just try to share this other question. Just give me a minute. So we can try to do this together. All right, so I have a question that I want to share with you so it can help us learn through these variances much easier. Let me just try to do like this. So you get to see that there's a relationship between this topic and the topic of budgeting, because we usually get the variances based on the budgets we have at hand. Okay, so that is one of the things that you may need to basically note. And then we've also seen the relationship between standard costing, okay, between the standard costing as well as between the budgeting. So that relationship is very key, but also understanding the principle of how each of the respective variances work is also very key for you. Okay, yeah. So just a moment here. So these variances are also not, as long as you master, you understand the formula, okay, and you understand the principle, like the way, like where we have seen, if it's labor rate variance, then I know it is the change in labor, okay, it's a change in the rate, okay. If it's material rate, okay, the material rate variance, then I know I'm looking at the value of materials, okay. So you need to basically understand the key terms when you're looking at the different variances. The same thing with the price, with the sales variances. If you're looking at the selling price variance, your focus should be to make sure that it's price that is being varied, okay, because it's price that is changing. Then if you're trying to look at the sales volume profit variance, or the sales volume variance, as some literatures may call it, then you know that there, my attention is actually doing what? My attention is to make sure that I'm actually removing, I'm looking at what was my sales volume vis-a-vis what did I actually plan to, as my sales volume, and what did I actually sell, okay? So that is very important for you. So I have a question here. It's in the iSpower book. I think you can, if you in the iSpower book, you might have it. So I just want to just show you something small for you to understand how these things play. Okay. So I want you to. So if you have the iSpower website, the iSpower book, it's on page 120. This is 100 page 120, 118. Okay, it's 118. It's 118. So it's example number 3. So it starts from here. There's just a small shadow here, but I believe you can see the amounts. Okay. So if you don't have the book, you may note some of these things, okay, or take screenshots and then you'll be able to note them down. So it says, using the illustration below, we can now calculate the first set of variances, which are the best, simple or best variances, okay? So we have this that they have given us first here is a standard costing statement, okay? So they have given us the selling price. As you can see, the selling price is 100,000. The respective costs are materials, labor, variable overheads, fixed overheads. They have given us the respective values. As you can see, 2 kgs are at 20,000 per kg, okay? This is the standard. So a unit product should definitely have these kind of values, okay? So as you can see, the labor that is required for a single unit of product is 1.5, and each labor is planned at 2,000 per hour, okay? Variable overheads are 1.5 at UJX 6,000 per hour, given that. Then fixed overheads, the same thing, okay? Like that. As you can see, one of the other things that you also see here is that the standard cost of production is 67. Now, 67,000 is a cumulative amount of the 40,000, the 3,000, the 9,000, the 15,000, okay? So that's very important. And then once you have that, because that is your standard costing statement, you also have your standard profit per unit. The reason why this standard profit per unit is very key is because we use it when we are determining our sales volume profit variance, okay? Remember they told us that our sales volume profit variance, we basically multiply what? We basically multiply the change between the budgeted and actual, the difference between the two, and multiply it by what? By our standard profit per unit, okay? So that is where we shall basically use that profit, okay? So once we have that, ours is to look at, of course, the next part of the question. So I hope you can see this next part of the question. Just try to enlarge it a little, okay? Okay, so the next part of the question goes ahead that the standard is set in advance and may differ from the actual results. That is, variance may occur, okay? So the other is the standard, and we are saying that it may actually differ from the actual results. So this is now the original budget. Like I said, these things work hand in hand. So that is the original budget. And as you can see, when it comes to the original budget, they have given us sales. So for sales, they expected to sell 50,000 units at how much? At 100,000. Production, they expected 55,000 units, okay? Then materials, they also give you different values: material, labor, variable overheads, then fixed overheads. As you can see, they have also given you the absorption rate. they're telling you that it is at 6,000 per hour, okay, and then 10,000 per hour there, okay. And when you move down, you also have this, the less closing stock, okay, and then able to get the standard cost of goods sold right there, and then the budgeted profit, okay. As you can see at the budgeted profit, they have also applied this, what we had the other side, which was the 33,000 was our standard profit, okay. So this alone gives you at least a demonstration, a relationship between the standard costing and budgeting. Even this 100,000, this 100,000 is the other side as our standard price, okay. And then also when it comes to this 20,000 per kilogram is what is on our materials, the other side. So that's why the two things actually have a relationship, okay. The standard cost statement and the budgeting have a relationship. So the 100,000 is here that I'm talking about. The 20,000 is here for the materials. The 33,000 that has been used is also right here. So they have some element of relationship between each other, okay. So once you have that, and then we are saying that ours is to look at the other part of the question, okay, right here. So this is it, okay. So that is our budget. As you can see, you find these values, even closing inventory. Closing inventory has been valued at the standard cost from the other side, okay. So we move down, then we have the actual results, okay. So as you can see up, we budgeted for 50,000 units, and down here we have 50. This is budgeted, but this is 53 units. The sales we able to sell 53,000 units compared to the 50,000 units that we sold, okay. And then we also have production, okay. We have production there, 56,000 units. Then we have materials. They also give us the respective values there. These are basically our actuals. And the reason why we have budgeted our actuals, then we are able to determine our variances between the two. So we are going to do the sales variances, do the material variances, do the labor variances, do the overhead variances, and so on. Okay. Yeah. So part of the question, they also gave us, this is what they gave us. Can increase the sum of the font size. As you can see, they also gave us a fixed budget, which shows the following variances. Actually, this is a flexed budget. Okay, so we have this is a calculation of what we just have the other side, the one we have just seen. So we have a flexed budget, and then we have actuals, and then we have respective variances. Okay, but this does not give us elaborate information. And what they are saying, however, the statement of above does not give enough details for management. We now have provide further analysis for that above example, and then we want to explain, of course, for example, explain why we spent 60,000 more than expected on the materials. Okay, so that is when these other variances come in: the sales variance, the materials variance, the labor variance, the variable overhead variance, the fixed overhead variance, and so on. So like from the information that we just had, okay, remember we just had some, we've been looking at each of the respective variances. Okay, so if somebody is asking you to determine the sales variance, yours is to go back and look at your respective sales variances, okay, and see how do I calculate my sales variances, and I want to try out here so that you're able to get an understanding, and maybe you can do the rest. Okay, so let's just try out the first ones. So they told us that under sales variances, okay, under selling variances, of course, we have the total selling variance, okay, the total selling variance, and then we have the selling price variance, which selling price variance looks at what the sales revenue should have been, and what for the actual quantity sold, and what it was. Okay, now if I'm calculating my sales price variance from this question, mine is to ask myself what is the sales revenue, what should have been the sales revenue for the actual quantity. Okay, now let's just see. When you come to, I'll put my pictures down. So if you see this, now the actual quantity that was sold is what? Is actually 53,000. Okay, the actual quantity that was sold was actually 53,000. Now, if we are determining the sales or the selling price variance, we are saying that we should look at the difference between what the sales revenue should have been for the actual quantity and what it was. So what it was is 5035, okay? What it was is 5,035,000. But what it should have been would be the 53,000, okay? What it would have been, it would be the 53,000 multiplied by what? Multiplied by this standard value of 100,000, okay? So as you can see, we are saying it should be the difference between what the sales revenue should have been for the actual quantity. The word for the actual quantity is very key there, okay? Because it means that you're going to use this as your quantity throughout. Here, when you're looking at the actual, you'll use this 53 times the 95 to give you this. Even when you look at your budget up here, yours is to look at the 53,000 times what? They increase the 100,000. You don't again look at this because they have told us what it should have been for the actual quantity sold and what it was actually was. Okay, so that's very important. So in getting the selling price variance, that is what we basically do. Okay, now remember what our notes here indicate. Our notes here told us something. They told us that the next is getting the sales volume profit variance. Okay, and they told us that this is the difference between the actual units sold and the budgeted planned quantity valued at what? Valued at the standard profit per unit. Okay, and this is where the standard profit per unit comes in, like what we have basically provided to us as the standard profit per unit. Remember, I showed you that standard profit per unit when we're trying to look at the first part of the question. Right here, we had the selling price. This is like I told, this is your standard costing statement, and that's why up here they have put the word standard UGX per unit. So this is your standard price, the 100, and then these are the respective costs. Okay, and then we are also having the standard profit per unit. So this is the standard profit per unit that we are going to use. So ours is to look at the quantity. Okay, ours is to now look at the difference between the quantities and then multiply it by that. So this is what we have. When you go up here, we are saying that, of course, the difference between the actual units sold and the budgeted. So these are the budgeted 50,000 and the actual units was 53,000. So 53,000 minus 50,000 should be able to give you a difference of 3,000 units. So the 3,000 units should be multiplied by what? Should be multiplied by the 33,000, okay? By the 33,000, which we have on our what? On our costing statement, okay? Right here, this 33,000 is what we do. So I'm just trying to help you to be able to interpret exactly what kind of information you have here when it comes to a practical number, okay? So as you can see, that is what we've basically done, okay? And then if it comes to, let's say, materials, okay? Remember, they have told us for material total variance is the difference between what the actual output costs us and what it should have cost us in terms of materials. We're able to also determine that using what we have, okay? Because already when you come to our question, when you come to our question here, we have materials here, okay? So as you can see, materials, we have 110 at 20,000 per kg, and this cost us 2.2, okay? This cost us 2.2. And then when you look at here, materials, we have bought is 130 kg at how much? At 2.7. And then we also have closing stock, okay? We have closing stock, which is 20 kgs at 20,000 times that. Now, remember what our notes are telling us to determine. They're telling us that to get the direct material total variance is the difference between what output actually costs and what it should have cost in terms of materials. So we can easily tell that actually, if you are to look at what it cost us, it actually cost us, I hope you were here. So it basically cost us 2.7 because that is what we bought, okay? We bought, and of course, when you bought the 2.7, we also have an element of what? You also have an element of closing stock. So you have a this 2.30 under materials here. Now, when you compare this with, compare it with your what? Compare it with your 2.2 here, because 2.2 is what you had budgeted in terms of your materials, okay? Now, when you're comparing this 2.2 with what you have here, then you're able to get the respective variance. But one of the key things that you also need to understand here, that with materials, we have a breakdown of these variances, okay? And maybe that will be able to help you pick something. So we have two cases here, because for the total, you just look at the total. But then we have what we call the direct material efficiency variance, okay? And they're telling us that this is the difference between the standard quantity of materials that should have been used for the actual, for what was actually produced, okay? Now, what was actually produced? What did we produce? What is our production? Let's just look at our production. So our production actually was 56,000 units, okay? Our production was 56,000 units. So this is very key. So they are telling us that we should get the difference between the standard quantity of materials that should have been used to produce the 56,000 units, okay? Now, from our budget here, we are saying that it's basically, we had planned to use 110 kg at how much? at 20,000 per kg. Okay. Now, if you also look at our standard costing statement, remember we have a standard costing statement, I think it is here, which tells us that materials should take 2 kgs. Okay, should take 2 kgs. So ideally, the material usage should have been 56,000 times what? Times our 2 kg. Okay, that is what it should have been. But what do we exactly use? What we exactly used is what we have right here. This is the original budget. Okay, this is the original budget. So this is like the actual. So as you can see, we actually have we have 110. Okay, we have 120. When you move down here onto the materials, I think you can see we bought 130. Okay, but we closed with 20 kgs. So it means that we actually used 110 kgs. So 110 kgs is what we use compared to the 56,000 times the 2 units that is on our standard costing statement. So we're able to determine what? Our material usage variance in kgs. Okay, we're able to determine our material usage variance in kgs. So that is very important that you understand that. And then this, similar to this, we have something here called the direct material price variance, which they are telling us that this is the difference between the standard cost and the actual cost for the quantity of material used or purchased. Okay, so we have the standard cost, which is on our costing statement, and then we have the actual cost. Okay, and then this, they're saying for the actual material, for the actual quantity of material used. Now ours is to come back to our costing statement. Okay, remember our standard cost of materials is 20,000 per kgs, and for the single unit this would cost us about 40,000. Yours is to ask yourself, so how much did it actually cost me? So when you come to your budget here, yours is to come to these materials. Remember, material price variance. Okay, so the material price variance, as you can see, we have 130 kgs that were bought. Okay, so you ask yourself, these were bought at how much? They were actually bought at 2,700,000. Okay, but what should it have cost us instead? It should have cost us 130 kgs times what? Times the 20,000 per kg here, which is 2.6. Okay, so the 2.6, the 20,000 times the 1,000, the 130,000 minus the actual 2.7 that we have here should be able to give you what? Your material price variance. Okay, so when it comes to the price variance, we are trying to look at what was actually purchased. Okay, so that is very important that you know that. So that's how you basically play with the respective variances, and that's how you're able to interpret accordingly. So once you have the knowledge of what exactly each of these variances relate to, okay, then you're able to play, because most of this information will definitely be provided to you. It's just the same thing with when we are getting to labor. I think there was somewhere where we had gotten to labor here. Okay, and they are giving us the labor rate variance, and they're telling us that this is the difference between the standard cost. The standard cost is usually provided by our costing statement. Okay, and then the actual cost of the number of hours paid for. Okay, now in the same way, of course, with this, we are now going to look at our actual budget. Okay, we are going to look at our actual budget or we call it, okay, calling it maybe the original budget. So we're able to find what exactly happened, what was actually exactly paid for. So if it is this case, means that we'll come here. Definitely before that, we'll come here and get, we see our labor. If, for example, we are looking at the labor rate variance, as you can see, 1.5 hours is at how much? Is at UJX 2,000 shillings per hour. Okay, so we have 2,000 shillings basically per hour. So hours is look for how many actual hours were used. Now, when you come to your question here, actual results here, actual results, they're telling us that labor 85,000 was paid. So we actually paid 85,000. Okay, and how much do we pay this 85,000? As you can see, what they are giving us is 180,000. So we paid 180,000 to 85,000 hours. So you just ask, how much would we have paid? It will be the 85,000 here multiplied by what? Multiplied by the standard rate of labor, which is how much? Okay, which is 2,000 per hour, because this is the standard costing statement. So 2,000 times the 85,000, you're able to compare it with what? Compare it with the 180,000 we actually spent. The difference between the two should be able to give you your labor rate variance. So you can go on and on like that to be able to determine and see how these variances work. Okay, yeah. So that is very important when it comes to the variances, and that's how variances work. Okay, we also have now, when under labor, we have what we call the labor efficiency variance. Okay, it is actually here, and they're telling us that this is the difference between the hours that labor should have worked for the units produced and the actual number of hours worked, valued at what? Valued at the standard rate per hour. Now, for our question, definitely the standard rate per hour is we found to be, I think that was 2,000. Let's just confirm. This is actually 2,000. Okay, so they are telling us that get the difference between the hours that labor should have worked for number of units actually produced and the actual number of hours actually worked. So ours now to go back and now look at the budget and the actual results. Okay, so as you can see right here, this is labor. Okay, so before that, let's just look at the actual. So how many units were produced? There were 56,000 units. Okay, now they are telling us that how many hours would labor have worked? Remember, when you get your standard costing statement, okay, the standard costing statement here, they tell us that averagely a single unit should take us 1.5, which is 1.5 hours. Okay, so if you're producing 56,000 units, it will be 56,000 units times 1.5. Okay, which would give you about, I think that could be about 84,000. Okay, so 84,000, you less it with what was actually the time that labor took. Now we are going to see the time that labor took. When you look at this question here, let's move to the actual results. You see what we basically have here. Okay, because we are looking at labor efficiency. They are telling us that labor worked actually 83 hours. Okay, they are telling us that labor actually worked 83 hours. So Get this 83 hours, subtract it from the 56 times the 1.5, you're able to get the labor efficiency variance. And then that should be multiplied by your standard cost per labor, which is 2,000, which is in the standard costing statement, but it is also here. Labor is budgeted at 2,000 per hour, and that's what exactly we have the other side. So that should be able to give you that. And then we have, we also have what we refer to as the labor idle time variance, okay? It is right here that I want to speak about. We have the idle time labor variance. And they're telling us that this is part of the labor variance, which represents the difference between idle and normal time. And they're telling us that for us to determine this, okay? For us to determine this, basically, it is the difference between the actual hours paid for and actual hours worked. Multiplied by what? Multiplied by the standard labor rate per hour, okay? Now, you know, when they speak about idle time, you're able to see it from here. Let's just see it from our budget. As you can see, actual results. Let's just move to actual results. You can see we actually paid for 85,000 hours, and then labor actually worked only 83,000. So there's idle time between this, and the idle hours here are basically 2,000 hours, okay, that we paid for, that we are actually not worked, okay. So that 2,000 has to be multiplied by what? By our standard rate per labor, which is 2,000, okay. So like that. So I believe that with that, you're able to get to interpret this narration with the other side, okay. So that's very important when it comes to variances, okay. Yeah, so that should be able to give you some guidance even as you read through the notes, okay. The notes are available, so you're able to relate the information. As long as you understand the principle, I believe the rest of the things can be much easier. The same thing when it comes to the overheads. This will not be very hard for you because you'll be able to relate through, okay? Because one of the things that when it comes to the overheads, especially fixed overheads, we also have expenditure variance. We also have things like volume variance. We have efficiency variance. We're able to relate the information basically from the question. If you have this book, you can easily go through the solution. But even if you don't have the book, you can be able to relate this information relating to what you are given, okay? Yeah, relating to what you've given. So this is the variable overheads. And like they are telling us here, for example, this is the variable overhead efficiency variance. They are telling us that this is the difference between the standard cost of the hours that should have been worked, okay, for the number of actual units produced, and the standard cost of the actual numbers actually worked. So in the same way, you just come to what you have right on your budget and able to see that. So we are right here. So you can see we have variable overheads. Then original was 82,500 hours, okay? When you move down, as you can see, under variable overheads, they are giving us 52,000, okay, right there. And remember, they have told us the number of hours that were worked still was 83,000. So we can be able to use that to determine the variable overhead efficiency variance, okay? Remember here, the variable, here they have not given us the hours, but these variable overheads work hand in hand with the labor, okay? So if this is the 83,000 that worked, is the same hours that we shall use when it comes to the variable overheads. Just like the way you see here, we have 82,500 and also 82,500 here, okay? but they are telling us that we should basically get the difference between these hours that we had planned and the hours actually worked, 82,500 and 83,000. And they're trying to tell us that this should be multiplied by what? This should be multiplied by the standard cost of the actual, by the standard cost of the actual number of hours. Now, when you look at your costing statement right here, remember they told us that even variable overheads at what? They are 1.5, it should take 1.5 hours at what rate? At 6,000 per hour. So we're able to get the rate from here, okay? So like that. So that's the kind of interpretation that you can basically do, and you can be able to go through some most of the notes, and then I believe you can relate, which is not even totally different from the fixed production overheads as well. It's all about comparing the budgeted with the actual, as well as also incorporating the cost statement as well. Okay, yeah. So I would love to end this class here. I have another class shortly. So I believe at least I've given you good guidance that you can use as a starting point, even as you're looking at this area, okay? Yeah, so thanks so much for joining through, and let's see how this can go, okay?